7 tips for a rewarding retirement. Whether you plan to retire in 5 or 25 years, the following ideas we're going to share with you today can make an impact on your retirement preparedness. But more importantly, following these best practice steps will start you on the path to feeling ready for your retirement. Start using these tips as soon as you can. Some will take time, others you can start right now. Before we jump in, it's a good reminder to consider when you plan to retire, how much you think you'll need to spend each year, how long you expect to live, what other sources of income you may have coming in, and whether you plan to leave money to others. The answers to these questions will likely change over time, but it's important to think about how some of those potential changes could affect your retirement goals or plans. So let's get started. Tip number 1. In all things, pay yourself first. Set money aside from each paycheck for you. There will always be bills, expenses, things we want, and things we need. You should view saving for your retirement as an absolute need and pay yourself first. In this way, you are effectively looking out for your future's best interest. Some examples of how you can do this include: rethink your tax refund. While it can be fun to spend this money towards items you've been wanting, using a tax refund check can be a quick and painless way to pay yourself first and start the year ahead of the game. If you feel you are behind on your retirement preparedness, look to put at least a portion of a tax refund into your retirement account. Automatic contributions to your 401k. Even if it's a small amount, consistently contributing to your 401k allows your money to work for you and grow over time. Create an emergency fund by setting up small, automatic transfers to a savings account for each pay period. This money should only be touched in an emergency, such as an unforeseen accident or job loss. In general, you should save a minimum of 3 to 6 months of funds to cover necessary expenses such as housing costs, insurance premiums, groceries, car payments, etc. Tip number 2. Paying off credit cards each month. Paying off credit cards can certainly be a challenge, especially if there have been employment issues, medical expenses, or insufficient income. There's just one way to stop racking up credit card debt. Evaluate where you can stop spending and then actually quit spending. Do you really need that new outfit or gadget? If you would struggle to pay it off by the end of the month, then try to say no. Take a candid look at any credit card balances you have, the card's interest rates, and your recent purchases. On your statement, find out how much is being charged in interest each month. Think about what that money could go towards if you were able to save or invest it instead. If there is credit card debt, start with either the highest interest balance or the lowest dollar balance first. Many people prefer to tackle the card with the smallest dollar balance first before moving to larger and more time-consuming balances. Whether you prefer to go after the smallest balance or highest interest rate, start with one and keep working at it until that debt is gone. This process will take time and dedication, but by being diligent, you could save thousands of dollars in the long run. Once any debts have been eliminated, do everything possible to remain debt-free and pay off any credit cards each month. Tip number 3. This goes without saying, but no one should be spending more than they make. In order to achieve any savings goal, it is first necessary to live within your means. It can be extremely difficult to accomplish this. However, your comfort and security in retirement are completely dependent upon setting aside adequate money ahead of time. There isn't a hard and fast number that will guarantee a comfortable retirement, but the general rule of thumb is to plan for 80% of your income today for each year in retirement. For example, we have Sarah, age 50, and she earns $45,000 per year. She expects to retire at age 65 and live until age 90. 80% of Sarah's income is $36,000, so she should be setting aside $36,000 for each year she plans to enjoy retirement. This means at age 65, she should have around $900,000 of savings set aside in order to maintain her current lifestyle in retirement. Multiply 80% of your current income times the number of years you plan to enjoy retirement. This number is your estimate of what you may need to accumulate by the time you retire. The best way to start preparing is to ensure you are living within your means today. Can you cook at home or bring lunch? Are there expenses that you have that you truly do not need or enjoy? It is much easier said than done, but evaluate your current expenses, look where you can cut some expenses, and do it. Tip number 4, keep an eye on your credit score. Your credit score greatly influences your ability to get loans, apply for jobs, and make big purchases. The 3 credit agencies are required to give you a free credit report each year. Make sure you check your score at least once per year. You could catch errors or possible fraudulent activity like loans taken out in your name. That 3-digit number has a much larger effect on your financial health than you might expect. A lower number can cost, at a minimum, tens of thousands of dollars in extra interest paid over your lifetime. If your score is on the lower end today, that's all right. Take a look at what might be hurting it and look to minimize those items on your credit report over time. In general, the best way to protect or improve your credit score is to pay bills on time and limit credit card balances. Tip number 5, evaluate if you may need life insurance. While we are not recommending anyone go out and purchase a life insurance policy today, it is important to understand how and why life insurance is used. Typically, life insurance is purchased when a person has a spouse and/or children to look after. In the event of a death, life insurance is meant to cover the income that person would normally have brought in. If you are married or have children, consider what your death might mean to your family financially. What expenses do you pay now that might need to be covered? A mortgage, medical bills, education? Many people consider 10 or 20-year level term policies, typically the least expensive type of life insurance available, which provide a death benefit only. In general, it is advised to keep the insurance only as long as it is needed, such as until your children graduate from high school or college. Tip 6, pay off your mortgage before retiring. While certainly easier said than done, if you pay off your mortgage by the time you retire, you can remove a significant financial burden from your monthly expenses. If you have an existing mortgage, paying an extra 15 to 25% each month can reduce the number of years remaining. For example, let's say 5 years ago, Jerry took out a 30-year fixed mortgage for $250,000. For the sake of this example, Jerry's interest rate is 4%, which results in a payment of just under $1,200 each month. If Jerry were to pay an extra $300 each month for 10 years, he would pay off his mortgage 5 years sooner and save about $37,000 in interest. It is worth mentioning that it is generally advisable to fund your retirement accounts prior to prepaying your mortgage. Tip number 7, confirm you have up-to-date will and estate documents. The best way to ensure your wishes are honored is to have the proper documents in place. The documents listed here should be considered for most individuals, regardless of age. Do you have a will? If so, has it been updated to reflect all of your significant life events that occurred since it was last updated? Some major life events that would require you to update your will include having another child, getting married, or getting a divorce. If you do not have a will, the court system decides how your property is divided and who will act as a guardian for your minor children. There are different power of attorney documents that control either financial or health decisions. It is important to note that the individuals you appoint for these roles should be close family or friends who you trust implicitly. Having these documents in place can save significant headache and financial stress for your loved ones in the event you are unable to make decisions for yourself. Thank you for watching 7 Tips Towards a Rewarding Retirement. Our goal is to help you make informed financial decisions given your personal situation and goals. Ultimately, the choices are yours to make. We are here to answer any questions you may have regarding these 7 tips. Please feel welcome to contact us at the number or email below. Thank you.